Hello everyone, welcome to the market opening bell for Thursday, February 5th, your 10-minute guide to the stock market. Dragged down by weakness in tech and internet stocks such as Tencent, the Hang Seng Tech Index fell on Wednesday, but the Hang Seng Index showed resilience with fluctuations leaning positive. The Hang Seng Index opened 37 points lower, dipped as much as 241 points in the early session to a low of 26,593, then rebounded in the afternoon to gain 169 points and reach a high of 27,004, ultimately closing up 12 points or 0.05% at 26,847. The Hang Seng China Enterprises Index fell 4 points or 0.05% to 9,048, while the Hang Seng Tech Index dropped 100 points or 1.8% to 5,366. Total market turnover decreased more than 14% day on day to $285.4 billion. Mainland funds total transaction amount reached $114 billion, with Southbound funds recording a net inflow of $13.373 billion, marking the highest level since January 21st. Specifically, net buying included Tencent Holdings at $2.231 billion, Alibaba at $1.171 billion, the CSOP Hang Seng Tech Index ETF at $1.123 billion, Xiaomi at $765 million, Meituan at $404 million, China Mobile at $350 million, its second consecutive day of net buying, Sinuk at $227 million, Kuaishou at $220 million, PopMart at $210 million, YOFC at $154 million, and others such as XXF Group at $139 million and Drinda at $103 million. Net selling was seen in SMIC at $706 million and Hua Hong Semiconductor at $235 million. Statistics showed that Southbound funds have net bought Xiaomi for 5 consecutive days, totaling $2.929 billion. Net bought Tencent for 3 consecutive days, totaling $5.49 billion. And net sold SMIC for 8 consecutive days, totaling $3.672 billion. Technically, the Hang Seng Index continued to fluctuate within the expected range of 26,500 to 27,100 points, closing still below the 10-day moving average at 27,091 points and the 20-day line at 26,857 points. If it fails to break above the 10-day line, it may form a bearish flat pattern and test support at the 50-day line around 26,250 points. The 3 major A-share indexes fell initially before diverging. The Shanghai Composite Index closed up 34 points or 0.9% at 4,102 points. The Shenzhen Component Index rose 29 points or 0.2% to 14,156 points. The Chinese index fell 13 points or 0.4% to 3,311 points, with combined turnover on the Shanghai and Shenzhen exchanges reaching 2.48 trillion yuan. The renminbi central parity rate against the US dollar was adjusted upward by 75 pips to 6.9533 per US dollar. Thanks to strong export performance and clearer policy signals, investment banks expect the US dollar renminbi rate to reach 6.9 by the end of the first quarter and 6.8 by the end of the second quarter, with forecasts of 6.7 by the end of the third and fourth quarters. The rating Doc China January General Services PMI came in at 52.3, above the market expectation of 52 and the previous reading of 51.7, indicating continued expansion in China's services sector activity. This latest figure also surpassed December 2025's 52, marking the highest in 3 months. Property stocks in the Hong Kong market rose collectively. On the news front, on February 2nd, Shanghai officially launched the acquisition of second-hand housing for use in guaranteed rental housing projects. An official from the Shanghai Housing and Urban Rural Development Commission stated that this initiative precisely addresses rental needs of new citizens, young people, university graduates, and various talents, serving as a strong measure to build a youth-oriented development city. Tencent fell again, dropping nearly 4% to $558, marking its fourth consecutive day of declines and hitting a new low since August 12, 2025. On the news side, WeChat announced measures against illegal links related to Yuanbao, restricting direct opening within WeChat. Yuanbao's official Weibo account said that it is urgently optimizing and adjusting its sharing mechanism and will launch improvements as soon as possible to ensure users' red envelope grabbing experience. The software and internet application sector suffered setbacks with Kingdee and Weibo and Weimob plunging 12.6% and 8.3% respectively, while CS and Chinasoft, Kingsoft, and Kingsoft Cloud fell between 5.1% and 6.7%. US AI startup Anthropic launched a new tool for in-house corporate lawyers that automates contract review, NDA classification, and brief drafting, which pressured SaaS and software stocks. Coal stocks rose with Yankuang Energy surging 10.6% after its transfer of Xintai Coal received the highest bid of 3.05 billion yuan. Mainland China is facing a new round of cold waves with heavy blizzards expected in multiple provinces, boosting China's Shenhua by over 5%. Yum China releases 2025 full-year results with total revenue of $11.797 billion, up 4% year-on-year. Net profit was $929 million, up 2%, with earnings per share of $2.52. Dividends per share were 29 US cents. For the fourth quarter alone, revenue reached $2.823 billion, up 9% year-on-year. Net profit $140 million, up 22%, and earnings per share 40 US cents. Operating profit grew 25% to $187 million, with an operating margin of 6.6%, up 80 basis points, driven mainly by improvements in food and packaging costs, property rents, and other operating expenses as a percentage of revenue. Restaurant profit margin reached 13%, up 70 basis points. Same-store sales grew 3% in the quarter, marking the third consecutive quarter of growth. By the end of 2025, total stores reached 18,101, with a net addition of 1,706 stores, of which franchised openings accounted for 31%. KFC stores total 12,997, up 12% year-on-year, and Pizza Hut 4,168, also up 12%. For 2026, the company expects capital expenditure between $600 million and $700 million, plans to return $1.5 million to shareholders, aims for over 20,000 total stores, net addition exceeding 1,900, and targets more than 30,000 stores by 2030. ZTO Express announced that 2025 total revenue is expected to range from 48.5 billion to 50 billion yuan, up about 9.5% to 12.9% from 2024. Gross profit is projected at 12.15 billion to 12.55 billion, down about 8.5% to 11.4%. The estimated revenue growth was mainly driven by parcel volume, rising to 38.52 billion pieces, up 13.3% year-on-year. but intense price competition significantly squeezed profit margins, showing the typical pattern of steady volume growth amid profit pressure from competition. Lee & Man Paper announced that it expects to record a profit of approximately 1.88 billion to 2 billion Hong Kong dollars for the year ended last December, up 38% to 47% from 1.36 billion dollars at the end of 2024. The profit growth was mainly due to improved marginal profits, reflecting enhanced operational efficiency and stronger product pricing power. In the U.S. market, AI stocks plunged again. The fear gauge VIX index rose 0.64 points or 3.6% to 18.64. The Nasdaq closed at 22,904, down 350 points or 1.5%. The S&P 500 closed at 6,882, down 35 points or 0.5%, and the Dow Jones closed at 49,501, up 260 points or 0.5%. The Nasdaq China Golden Dragon Index, reflecting Chinese concept stocks, fell 148 points or 1.95% to 7,461. Among major tech stocks, Nvidia fell 3.4%, the largest decline among Dow components. Tesla dropped 3.8%. Data from the China Passenger Car Association showed Tesla delivered 69,129 China-made EVs in January, up 9.3% year-on-year, marking the third consecutive month of growth. However, deliveries of Model 3 and Model Y from the Shanghai factory, including exports to Europe and other markets, fell 28.9% from December. Chip stocks were hit hard, with AMD plunging 17.2% after disappointing quarterly revenue guidance. Micron Technology fell 9.5%, Oracle dropped 5.1%, and Palantir fell 11.6%. Funds flowed into traditional consumer stocks, with 3M and Nike rising 5% and Apple up 2.6% to push its market cap above $4 trillion, slightly surpassing Alphabet to become the world's second largest listed company by market value, behind only Nvidia. Eli Lilly reported better than expected latest quarterly results, with revenue up 43% year-on-year to $19.3 billion and adjusted earnings per share up 42% to $7.54, both exceeding forecast. The company guided 2026 revenue between $80 billion and $83 billion, likely above expectations, driving the stock up 10.3%. Yum Brands announced fourth quarter net profit up 26% to $540 million, with adjusted earnings per share of $1.73 versus expected $1.77. Revenue rose 6% to $2.51 billion, above the expected $2.45 billion. Global same-store sales grew 3%, driven by strong international performance at Taco Bell and KFC. Taco Bell same-store sales rose 7%, above expected 5.6%. KFC's rose 3%, also above expectations, though U.S. same-store sales at KFC grew only 1%. Pizza Hut underperformed again, with same-store sales down 1%, mainly due to a 3% decline in the U.S., slightly worse than the expected 1.7% drop. Qualcomm released after-hours results for the first fiscal quarter ended December, with net profit down 6% year-on-year to $3 billion and adjusted earnings per share of $3.5, above expected $3.41. Revenue grew 5% to $12.25 billion, slightly above expected $12.21 billion. However, due to global memory shortages, the company guided current quarter adjusted earnings per share between $2.45 and $2.65 and revenue between $10.2 billion and $11 billion. Compared to expectations of $11.11 billion in revenue and $2.89 in earnings per share, the stock fell 9% in after-hours trading. U.S. private sector employment added only 22,000 jobs in January, 226 below the market expectation of 48,000. December's figure was revised down to 37,000. ISM data showed the U.S. January services PMI holding steady at 53.8, above the expected 53.5, indicating continued strong expansion in services. S&P Global PMI showed the U.S. Services Business Activity Index at 52.7 in January, up from 52.5 in December, and remaining above the key 50 level for 3 consecutive years of services expansion. The composite PMI output index rose to 53 in January, from a flash 52.8 and December's 52.7, signaling steady growth momentum in the private sector. Our stock pick today is China Shenhua, stock code 1088. China Shenhua recently announced its estimated results, expecting attributable profit to shareholders for the 2025 fiscal year to range from 50.8 billion yuan to 55.8 billion. This represents a year-on-year decline of 18.6% to 10.6% compared to 2024, which is basically in line with market expectations. The group's production and operations have remained stable, with its core advantages in integrated operations continuing to strengthen and secure stable energy supply effectively guaranteed. However, due to changes in the industry supply-demand dynamics, coal sales volume and average selling prices have declined, leading to a year-on-year drop in operating performance. Looking ahead to 2026, with the expansion of data centers, increased AI computing loads, and the widespread adoption of electric vehicles, China's electricity demand growth is expected to accelerate again, supporting a rebound in coal demand. Meanwhile, with slower supply growth, coal prices in 2026 are anticipated to rise compared to 2025. Additionally, policy changes in Indonesia regarding coal exports and production are providing significant support to global coal prices. Indonesia accounts for nearly half of the world's seaborne coal supply, and its export restrictions are expected to substantially narrow the global supply surplus of approximately 320 million tons. The Indonesian government plans to reduce coal production in 2026 to 600 million tons, a 24% decrease from 790 million tons in 2025. Estimates suggest that if production is ultimately cut by 20%, low calorific value coal prices could surge by 40% to 70%, while high calorific value coal prices may rise by 10% to 20%. Due to the production quota reductions, Indonesian miners halted spot coal exports in early February this year and are currently only fulfilling long-term contracts. At the same time, Indonesia has confirmed that starting in 2026, it will impose an export tax on coal ranging from 5% to 11%, which will directly increase export costs and be passed on to international buyers. At the end of 2025, China Shenhua launched an asset acquisition from its parent company, China Energy Group, including 100% of Huoyuan Power, 100% of Xinjiang Energy, 100% of the chemical company, 100% of Wuhai Energy, 100% of Pingzhuang Coal, 41% of Shenyang Coal, 49% of Jinshen Energy, 100% of Baotou Mining, 100% of the shipping company, 100% of the coal trading company, and 100% of the port company. The total acquisition price is 133.6 billion yuan, with approximately 70% paid in cash and the remaining 30% through the issuance of new A-shares. This transaction is regarded as the largest scale asset restructuring in China's energy history. Through this deal, the group will acquire high-quality coal pitted coal power and coal chemical assets from China Energy Investment Group, optimizing the integration of the industrial chain resources, enhancing asset quality, scale efficiency, and risk resilience, while reducing costs and boosting profitability. Upon completion of the acquisition, China Shenhua's resource reserves and production scale will see explosive growth. Specifically, coal reserves will increase by approximately 65%, reaching a total of 68.5 billion tons. Recoverable coal reserves will rise by 97.7% to 34.5 billion tons. Annual coal production capacity will increase from 327 million tons to 512 million tons, a growth of about 57%. Thermal power installed capacity will rise from 47.6 gigawatt to approximately 60.9 gigawatt. In the coal chemical sector, polyolefin production capacity will surge 213% from 600,000 tons to 1.88 million tons. At the same time, the acquisition will significantly improve operational performance, with the acquired assets expected to contribute more than 9.4 billion yuan in annual profit. Although the cash payment is substantial, China Shenhua holds cash reserves exceeding 80 billion yuan. Management has committed to maintaining a high dividend payout ratio, increasing the minimum payout ratio from 60% to 65% for 2025 to 2027, and the cash flow generated from the asset injection will support future dividends. Recommendation: buy at $41.5, target price $46, stop loss at $39.5. I do not hold the above stock.